Marietta, you did it. GoFundMe told us about it. #1 most generous city in the country. And here at Coffee with Your Retirement Coach, we want to raise a mug.
Raise a mug.
There we go.
To Marietta.
Marietta.
All right. Grab your favorite mug. It's time for Coffee with Your Retirement Coach. Welcome back to Coffee with Your Retirement Coach. We're bragging on Marietta, but many of our viewers and listeners are generous in nature. And today we want to talk about how you can turbocharge, and then this is where we're going to drop in the sound effect. The engine's going, how to turbocharge your generosity. Clipboard's out. Hi, I'm Aaron, and with me today, we've got Randy and Nic. Randy, how we doing?
Doing great, buddy.
Awesome. Nic, thanks for being here.
Hey, as always.
This is an exciting announcement. I mean, Randy,
it's really cool.
And I think you've been Marietta longer than the two of us, so you've watched a lot of incredible stuff happen.
First of all, I think generosity tells you a lot about confidence that people have, and it's such an honor to serve people who are willing to give. And I'm a big believer in, if you sow, you reap. Yeah. I think Marietta's been doing a great job. I love the fact that what we're going to do is show people how to ramp up the giving. Same giving, just make it better.
Yeah. Yeah. Well, and, I grew up here. And while I do live in Cobb County towards Ackworth today, our business is planted right here in Marietta. Yeah. We have clients in roughly 20 states, and we love our community. We love Metro Atlanta, but there is something special about this square area, the city of Marietta. And again, I'm just honored to be around such generosity. And when I first read that, I was like, wow, we really are around some super generous people.
Absolutely.
Now, the two areas that we're going to focus on today, it's not an exhaustive list. These are just two exciting things, and they're really inspired by recent reviews in office. We're going to talk about bunching, and we're going to talk about QCDs. And again, out of context, that might seem like, I guarantee you this is probably still the podcast for you.
No, I mean, this is actually a really, really great episode for those that want to continue in their generosity. Yeah. It really is. Because you could take somebody who's really wanting to be a great steward of their assets, but, with great stewardship, we want to empower you to really maximize the benefits that you're receiving from a tax perspective, but also maximize the benefits to those organizations you care about. And so this comes back around to bunching of deductions. So what if you had a tool that you could put multiple years of giving and get all the tax benefit in 1 year, so you supersede, Randy, that standard deduction, which is much higher today.
Yes.
So you're getting that big tax benefit, but then what I love about this strategy, you control when, how frequent, how many years you give to those organizations you care about.
Let's just talk about that for a minute. So what we're finding, a lot of people, because of how high the standard deduction is, and it may go higher, that they're still giving, but they're no longer get to deduct their giving. So many people don't get to do that. However, they could, and all they'd have to do is change their thinking from how they do everything today to being a little bit more strategic and bunching their deductions into 1 year so that they would exceed that standard deduction. So somebody who wanted to do that over a 3-year period, but they're still going to give the same amount to the charities and the organizations they care about. How do they do that?
Well, there's a tool, and for those of you in our audience today who would like a white paper that kind of walks through some of the specifics, you can connect with us and request this at connect@yourretirementcoach.com. We'd be happy to send you that resource. But a donor-advised fund, we've done a prior episode where we talked about this. It is a smart financial planning tool for those who are generous. Yeah. I think it's going to continue in popularity, especially as the standard deduction remains so high. But what if you gave, instead of writing the check on Sunday to the church or to your local theater or museum, what if you actually did multiple, you didn't write the check, but instead you transferred a highly appreciated asset like a stock, a mutual fund, ETF, etc., piece of real estate. Yeah. You transfer that into your donor advised fund. You got a massive deduction deduction, multiple years of deductions all in 1 year. And then from there, you decided when and how frequently you gave to those organizations you cared about.
Right.
That is a powerful tool.
Right.
So just for clarity, so say I gave $10,000 a year, and instead of giving $10,000 a year and not getting to deduct it over 5 years because my standard deduction exceeded that, I gave $50,000 in 1 year from appreciated assets. Let's walk through this just for a second. And that allowed me to get a deduction this year that I wouldn't get. But every year I still give the $10,000, but instead out of my checkbook, out of the donor advised fund.
100%.
Okay. And in addition to that, what I did is if I took a stock or an ETF that I paid $10 for per share, that's now worth $50 per share, and I donated that, I wiped out all that unrealized capital gain. And I've still got my cash, that $10,000 I was going to give every year. I've still got that.
Well,
so I could go back and buy that investment or that security that I gave to my donor advised fund and reset my cost basis.
100%. And I think that's what, this really is having your cake and eating it too.
It is.
It really is. Because if you do have that appreciated stock like, Amazon or Apple or Meta or whatever it is that you have, and it's just gone through the roof, and what you could do is avoid capital gains taxes legally by transferring shares, part or all of that asset, over into the donor advised fund. Now you've got the deduction, you avoided the capital gains tax, and that asset now can be given or it can be sold and then given to those organizations you care about. It's a triple threat.
And a matter of fact, unlike foundations and that are very expensive, these are really low cost to no cost type of investment vehicle or tools, excuse me. And remember, we're going to put this disclosure in here, but don't do this without getting some advice, especially your CPA. You want to work with somebody who's knowledgeable about this. But Nick, just on a personal note, so what I do for my giving is instead, I used to give out of my checkbook. I used to give out of my cash flow all the time. And what I do today is I run a report and I find my lowest basis, those securities that I've had the greatest gain in, and I donate those to my donor advised fund. And I do almost all of my every year giving now out of the donor advised fund rather than giving cash. And so think about what I'm doing. If I'm gifting something that has a very low basis, and I still like the security, one of the securities you might have mentioned. I still like it, but I donate it. I've still got my cash because I donated the security. Now, what I do is when I go back and buy, I could go back and buy that exact same security that I gave to the donor advised fund, but now my basis is today's value. So I got the deduction for the gift using the donor advised fund, but I've still got my cash. And so in addition to that giving, which is wonderful for the community and the organizations I care about, I actually benefited myself in another way. Not only the tax deduction, which is awesome, but I also repurposed it and I bought back investments that I like at today's basis. So I no longer have that gain.
Well, and so this is so good on so many levels. But I like how you also said meet with the CPA, seek wise counsel, because there are also those gotchas like a wash sell rule. Yeah. So you have to be careful with the timing of when you repurchase a security. You have to be careful what kind of security you buy afterwards. So there are a lot of nuances, and that's why coaching really makes a lot of sense, because a coach can guide you to get the best, the biggest bang for your buck from a tax benefit standpoint, just like you're doing for yourself right now today. We can help other people do that same thing and get the biggest bang for the buck. And if you're saving more money in taxes, here's what I love. That's more money that you could give to those organizations you care about. Yeah. You have more money in your hand that you can even benefit them to a greater extent.
So I want to give a real world scenario because I feel like sometimes it's helpful when we can see ourselves in a situation, right? Had a client last year. They've owned Southern Company for so long and bought it at such a low basis that if they were to have sold it, they'd have had to pay for the profit, right? They'd have been taxed on their profit. And so they were afraid and they just left it alone. They never touched it. So they've got this beautiful, wonderful thing that just sat there, right? So it's over there. Typically, they gave to their church, Must Ministry, and St. Jude's to the tune of about $10,000 to $11,000 every year. So significantly under the standard deduction, but a powerful gift, a generous gift, right? Well, last year it was the California wildfires that brought up the conversation. They're like, we're thinking about doing a few $1,000s. We feel like this is horrible. We want to give towards it. And they're like, but we're still not going to break the standard deduction. And I said, no. And then they brought up from our class, the donor advised fund. They said, here's what we want to do. We want to utilize the Southern Company stock that's been sitting there that we've been afraid to touch. We've got a bank CD that's renewing that we're very unhappy with the rate, so we want to turn a negative into a positive, and then we're going to take what we would have gave. And they wanted to do about 5 years worth of gifts. And again, you have to have the pieces. There has to be the math equation has to work. So there's either got to be the cash or the securities to make that kind of an initial funding, but it can be so much more attainable than what people think.
I think the key of what we're talking about right here, because we're just giving people little bits and pieces, is to have a plan and work the plan, because there are moving parts here that when they're put together in a synergistic pattern, they really are much more optimal.
Yeah.
And so, yes, each of these things are good by themselves.
Yeah.
But together, it's even better.
Just like the city of Marietta.
Just like
one of us giving is one thing, but all of us giving, that's an impact.
But let me wrap up, because what I wanted to say was, Nick, to your point, she rounded up.
Yeah.
She gave more than what she was initialing, and it opened the door to additional tax planning.
Yes.
That she'd been kind of a little bit
and
stiff-armed previously.
That's right. And I think, just in the interest of time, the QCD, Nick, can you share, how do we use that? How cool has that been?
It's awesome. I mean, honestly, it's so good I can't believe it's allowed. But, QCD stands for Qualified Charitable Distribution, okay? And so, at age 70 and a half, the old required minimum distribution rule, if you had retirement accounts, is that you would have to start giving according to your life expectancy table. And every year you'd have to make this gift. And then if you got the gift number wrong, it was a 50% penalty, etc.
Yeah.
No one liked it.
No.
And then you've got a lot of people today, they don't necessarily need the money out of their IRAs, but the government forces you to take it through required minimum distributions.
Yeah.
Well, the new required beginning date to start that is age 73 as of today, okay? The IRS came out and said, you know what? We do want to continue to encourage gifting. We want to encourage charitable intent. Yeah. So we're going to leave this QCD rule, we're going to allow that to stay age 70 and a half.
Right.
So you're now, the maximum you can give as a QCD, Aaron, it was $100,000. What is it today? Do you remember?
Oh, dude, we got an increase. I believe we're at 108. Is that right?
$108,000 now per person, right?
So a couple could do
216,000.
Yeah.
So if you wanted to take your required distribution again, the maximum you could do 108,000 as a single, 216,000 as a couple. What you're allowed to do is direct that required distribution starting at age 70 and a half life expectancy tables and direct it to those organizations you care about.
Yes.
Okay. Now, why would somebody do that? Number one, it will not count as taxable income.
Right.
Okay, so it won't push you into higher tax rates. It does not count as taxable income. And number two, zero taxes. This is better than taking it and getting a deduction. This really is about as good as it gets.
So let's just talk about the retirement account, the traditional retirement account. We always talk that the traditional retirement account has a mortgage on it, and that's the amount that the government gives. So by giving this way, giving from the IRA, you're wiping the mortgage out on that gift versus giving your cash again. So your dollar is potentially up to almost 40% more. And I was thinking about this in the clients that we've worked with who have been major donors for some of the organizations around. It could be their church, a building project, could be something like Musk Ministries or, the Strand, some organization that they really care about. And they want to do a big donation. Now, if they give from their IRA, they've wiped out the income tax on that IRA.
Right.
And they've still got their cash that they might have considered, but they have to know that they can do it. And that's why I think the synergistic approach is so important, to look at it that way and be aware of it. And I think people got confused, Nick, to your point. When the IRS changed the rules to where the required beginning date was going to be 73, and in some cases, many people, it's going to be 75, and we don't know what it'll be in the future.
Right.
But they didn't change that 70 and a half. So people could even though they haven't hit required minimum distribution.
Yeah, exactly.
But talk about required minimum distribution in the QCD.
Yeah, so with your required distribution, again, this is based on your mortality table. The IRS has a table. You can go to irs.gov. You can pull it up. You can see what that factor is that you multiplied. Now, a required minimum distribution is based on all of your before-tax retirement accounts, save one that I'll talk about in a second, one caveat here. So those before-tax retirement accounts or even after-tax IRAs, and it looks at a snapshot of the balances on December 31st. And it does the calculation of that mortality rate based on that end-of-year value on all of those retirement accounts combined, and then that tells you what your required distribution is for that following year. Now, I know that might be a little bit confusing, but
so say it was my RMD was $25,000.
Yeah.
And I normally give $10,000 to the church.
So what's beautiful about this, you don't have to give all $25,000. You could just give the $10,000 that you normally give to the church out of that $25,000 amount. And for many custodians, all that is a form.
Yes.
It's as simple as working with a back office administrator. It's writing in who the organization is. It's filling out the $10,000 of the $25,000, and then you could choose to keep the remaining $15,000.
So I think it's really important that we make sure that our listeners know this. So not everybody that does this knows how to do it effectively. And the second thing is why we always encourage people to work with their bookkeeper, their accountant, their CPA, is we have found people who have done this on their own missed the fact that they could have had that. They're still claiming it on their income, even though they didn't have to because they didn't know to tell the CPA so the CPA could correct their tax return. Yeah. So I think it's important to work together on that.
And just for clarity there, what you meant, Randy, was that they aren't claiming the QCD and they're fully putting their RMD
right,
as
they're
taxable
showing the
income.
whole RMD without letting the without letting the CPA know that 10,000 of the 25,000 actually went directly from the custodian to the charity. And again, it's a little miss, but the other one they do that I know, Aaron, you've seen this before, is they'll do the donor advised fund, they'll do a big donation and not tell the CPA that they did it and not get the deduction.
Well, and so here's one thing that I do want to put, here's one of the big mistakes I see.
Yeah.
So a lot of people try to pair the two of these together.
You can't do that. Yeah.
And this is a big one. So for our audience today, this is big.
Yeah.
I need y'all to pay attention to this one. Let's say you want to execute a donor advised fund. You want to put that in place. You think it's powerful, multiple years of deductions all 1 year. You want to take advantage of the QCD. You want to, not have that required minimum distribution count as taxable income. What you can't do, it's disallowed, is direct your required distribution amount to a donor advised fund under a QCD and it not count as ordinary income. Right?
I think we ought to put that in the big bill.
The big beautiful bill. So you cannot do that. You will get taxable income on that required distribution amount, and you will get a tax deduction, but you kind of defeated the purpose of taking advantage of the QCD. And here's the last one that I want to leave us with. One of the big advantages I also see for a lot of people, again, Seek-wise counsel, is a lot of people, they don't really necessarily care how much money you make them. They pay attention to these two things, though, I promise you, their tax bill and their Medicare premiums.
I was just about to say, no smile is bigger than the person that avoids forced taxation or is able to combat.
And so the beautiful thing about a QCD,
besides the big beautiful bill,
is
a big beautiful QCD.
Big beautiful QCD. Can we tag that?
We should.
All right.
We should take it
All
next.
right. But seriously, for a second.
Yeah.
So the QCD, not only does it help bring down your taxable income and potentially reduce your tax liability, it potentially also reduces your Medicare premium or keeps you from going into a higher Medicare premium.
Yep.
So for people who are concerned about taxes, they don't need the required distribution necessarily, and they're concerned about not going higher in their Medicare premiums, a QCD could be a smart tool.
You know, even though you can't do them you can't do IRA contribution or distributions into your donor advised fund. Just a note, the two together can actually be very powerful. And one strategy that we've used with a lot of clients is prior to 70 and a half, those that are generous, like our Marietta citizens, they're doing donor advised fund. And once they hit 70 and a half, instead of doing the donor advised fund, they flip over and do the QCD.
Yeah.
But it's a plan, it's a strategy. And I think the key is be knowledgeable about this. Either if you're a do-it-yourselfer, figure this stuff out and take advantage of it. If you're working with other financial professionals, if they don't know how to do it, you may have to teach them. And then, if you're working with more of a planning group, they should be bringing this to the table to you as we do with our clients. So I think that's a great episode. I appreciate the insights that we're being able to offer those generous people that are already giving. We just want to help them get more for what they're already doing.
Well, and Randy, I tell you, it's still the rarest thing I see. Somebody working with a financial professional that has actually reviewed their tax return.
Yeah.
And so, again, if you aren't having somebody proactively review these things for you, I'm really glad that you're tuning in today. Mm-hmm. I think this is a great jump start, but I would suggest don't try to go this alone. Seek the wise counsel out there, because the only thing worse than not doing this is doing it wrong.
Yeah, no, I would agree. Now, our experience with our clients has been that those that work on these tax optimizing things, these strategies with their giving, they just get more generous. They live more fulfilling lives. And we want that for everybody. So we want you to be generous with this episode. We want you to share it with others. If you're in Marietta, do not be afraid to share this with our friends in Kennesaw, Austell, and even up in Alpharetta. We want competition because we're going to still win most generous. Be a big friend to those people. Share this episode. Be generous in that way. Thanks for sharing your time with us. Thank you for being coachable, and we ask that you stay coachable. We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@yourretirementcoach.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. On behalf of our coaches, we want to thank you for listening and for being coachable.
Yeoman's Consulting Group, a registered investment advisor YouTube channel based in Marietta, Georgia. We strive to provide comprehensive wealth management services for every stage of the journey. This platform is solely for informational purposes and is not offering advisory services or sales of securities. Investing involves risk and possible loss of principal capital. Comments by viewers or recognitions are no guarantee of future investment outcomes and do not ensure that a viewer will experience a higher level of performance or results. Public comments posted on this site are not selected, amended, deleted, or sorted in any way. If applicable, certain editing of personal, identifiable information and misinformation may be deleted. The opinions expressed herein are as of the date of publication and are subject to revision due to changes in the market or economic conditions and may not necessarily come to pass. Just come in and record. Learn more at thepodium.studio. Step up to the podium.